Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special economic weather report brought to you in association with the BNZ. Today we look at inflation, and this of course is important because the Reserve Bank watches it and the official cash rate is set to keep inflation between 1 and 3% over the medium term. So, inflation up 0.3% in the June quarter from the March quarter and up 1.8% for the year. This was actually lower than most economists and the Reserve Bank forecast. The economists were looking for 0.4, they got 0.3. The Reserve Bank was looking for 0.5, and they got 0.3. But is this enough to delay the Reserve Bank from hiking the official cash rate again? Remember, back on June 10, it increased the official cash rate for the first time in over a year from 2.5% to 2.75%. And the expectation then was that the Reserve Bank would keep increasing that official cash rate notch by notch over the next year or so. And most, however, see the Reserve Bank continuing to increase that official cash rate, even though inflation seems a bit lower and the economy doesn't seem to be accelerating away as fast as some people had expected. But let's have a closer look behind these inflation figures to find out what's going on and what's coming up next, because remember, the Reserve Bank looks 1-2 years out. When you look at what's happening in the next half year or so, we're going to see increases in ACC levies, which will be passed on higher insurance costs. The emissions trading scheme costs will kick in. And of course, there's the GST hike from 12.5% to 15%. Now, of course, the Reserve Bank can look through these increases in inflation, but it will be tough to keep those inflation expectations low. So the Reserve Bank has to be careful. And when you look to the makeup of the inflation, it's clear that domestic inflation is still a bit of a problem. It's up at 2.2% annually from a year ago. Tradable inflation up at 1.1%. Remember the difference, non-tradable, that's stuff that's domestic, not subject to competition, nothing to do with export and import prices. Tradable inflation, that's all about import and export prices, food, that sort of thing, anything that's subject to the export sector. And that's at 1.1%, relatively weak. No doubt the New Zealand dollar's strength in the last 6 months or so has helped that. Now the Reserve Bank, again, needs to keep the official cash rate at a level which keeps the inflation rate between 1 and 3%. And its own forecast for inflation is near the top of that band for the next couple of years, so it has to be careful. Now the markets are saying the official cash rate will rise by another 1.25% over the next year or so. That will take it from 2.75 to 4%. Now, what would that mean for interest rates? Well, if that was passed on, the same amount, you'd see floating mortgage rates rise to well over 7% in a year or so. Fixed mortgage rates, well, a bit harder to say because they depend on what's happening in the wholesale markets and also what margins the banks want to put on top there. But they're definitely headed for 8%. That's because bank funding costs are rising. And we're seeing, particularly with deposit rates, term deposit rates for mums and dads here in New Zealand, they're likely to rise well over 6% as well if the official cash rate rises as the market expects. So, there we have it. Inflation up, but not as much as expected. But the Reserve Bank's still looking to increase the official cash rate. And July the 29th, not this Thursday, but next Thursday, is the key day here. Most people are still expecting another 25 basis point hike in the official cash rate. Of course, we'll see. Keeps us interested here at interest.co.nz. That was a special economic weather report brought to you in association with BNZ.